Do your emotions drive your investment decisions? You may not think so, but that doesn't mean it isn't true. When it comes to the emotional aspects of investing, it's our behavioral biases, those potentially damaging behaviors which produce illogical or irrational decisions that usually bring suboptimal and often negative outcomes. So let's start by examining 7 behavioral biases, what they look like in everyday decisions, and what effect they could have on your investment decisions. Our first behavioral bias is known as loss aversion. Now, loss aversion refers to people's tendency to prefer avoiding losses to acquiring equivalent gains. In everyday life, it might look like your unwillingness to sell your house for less than you paid for it. Or the fact that most people would rather risk gaining $1 than risk losing one. When it comes to investments, it means people recall their losses more vividly than their gains. And it could mean selling to avoid further loss when the reasoning for the investment says, buy more. Another bias is known as the confirmatory bias. Now, this is the tendency for us to search out, interpret, favor, and recall information in a way that confirms our pre-existing beliefs. For example, people who support or oppose a particular issue will not only seek information to support that issue, but they'll also interpret news stories in a way that can uphold that belief. They might even remember things in a way that support their position. Likewise, an investor may have an idea about market conditions and lean towards information sources that endorse that belief. Our third behavioral bias, mental accounting, refers to the tendency for people to separate their money into separate accounts based on a variety of subjective criteria, like the source of the money and the intent for each account. People often refer to a savings account as an emergency fund or rainy day money. Mental accounting could explain why people would willingly pay $9 for a beverage at a sporting event, but would never think of doing so in a grocery store. An investor could view a stock differently if it were inherited. They have an emotional attachment to that security. If you own stock in a company that you used to work for, there can also be an emotional attachment. Now, the hazard here is that when people refuse to diversify their position because of their emotional attachment, they could be subjecting their portfolio to risk. And this is a fairly common problem. Our next behavioral bias is illusion of control. Now, that's the tendency for people to overestimate their ability to control events. It occurs when someone feels a sense of control over outcomes that they clearly do not influence. Now, it's thought to influence gambling behavior and even belief in the paranormal. When the illusion of control is operating in financial markets, traders often feel that they have more control over the market than they really do. Now, one study has shown that the more traders think they are in control, the worse their actual performance. According to Dimensional Fund Advisor's article, Quit Monkeying Around, there's an often discussed idea that blindfolded monkeys throwing darts at pages of stock listings can select portfolios that will do just as well, if not better, than both the market and the average portfolio constructed by professional money managers. Our next behavioral bias is the hindsight bias. Now, that's our inclination after an event has occurred to see the event as having been totally predictable, despite there having been little or no objective basis for predicting it. For example, the day before that big important World Series game, your friend predicts his or her team is going to win by a very large margin. And in fact, your friend's team does end up winning the game, causing your friend to believe he or she predicted it. Haven't you ever thought to yourself, I knew that was going to happen. And after a while, you start to believe that you really did know beforehand. When investing, hindsight bias can make the past look predictable and cause investors to become overconfident in their ability to buy and sell securities. Believing that one is able to predict future results can lead to picking stocks not for their financial performance, but for personal reasons. Herd mentality, behavioral bias, describes how people are influenced by their peers to adopt certain behaviors. Now, researchers at Leeds University performed group experiments where volunteers were told to randomly walk around a large hall without talking to each other, and a select few were given more detailed instructions on where to walk. The scientists discovered that people end up blindly following one or two instructed people who appear to know where they're going. Now, when it comes to investments, an example of herd mentality could be you're watching a particular stock. You notice a lot of investors are buying, and you are tempted to buy too. Now, what's the risk? Well, by the time you notice the upward trend, others have already reacted. Herd mentality can lead to security becoming overvalued, and in that case, your emotion could cause you to make a bad decision. Our next behavioral bias, the recency bias, is simple. As humans, we are inclined to use our recent experience as basis for what will happen in the future. We drive the same way to work, we eat at the same restaurants, and we shop in the same stores. When stock market participants evaluate their portfolio performance based on recent results or on their perspective of recent results, it can lead them to make incorrect conclusions that ultimately lead to incorrect decisions about how the stock market behaves. Until recently, we've had a 9-year run of pretty much a bull market. Now, could it be that some investors have been so inclined to think that this is going to continue and weren't expecting our recent correction? We may not be prepared for it in that case. Now, why is being aware of your behavioral biases so important? Well, being aware of your own behavioral biases can lead you to make better decisions. And in his book, Behavioral Finance and Wealth Management, Michael Pompian describes 4 of the most common types of investors. Now, I want you to consider how you would describe yourself. The type of investor you are could determine which behavioral bias you're most likely to lean on. Our first investor is known as the preserver. He or she values financial security and wealth preservation over growth. Losses are much more painful to bear than gains are to be experienced. Now, the preserver values financial security. They want to keep their assets. They prefer to avoid risk. Now, this could cause the type of investor to obsess over short-term performance. One of the most likely biases the preserver will exhibit is loss aversion, avoiding loss at the expense of gain. Our next investor is known as the follower. Now, followers are passive investors who lack interest or possibly the capacity to understand investments. And the follower tends to follow the lead of others or look to current trend to make investment decisions. They may even pat themselves on the back when they experience success. Following the lead of others could cause that type of investor to invest at the wrong time. When stocks are overpriced, followers generally lack a long-term plan. Herd mentality is the dominant bias in this personality type. Our next type of investor is known as the independent. Independents are involved and unlike the follower, they have their own ideas about investing. They are likely to have and follow a plan and to achieve their goals. They can be analytical and they're able to apply critical logic. They are willing to take risk and act decisively. The independent could unknowingly be leaning on that confirmatory bias. Remember, seeking out information that actually supports their position. Our last investor is known as the accumulator. And accumulators want to accumulate wealth. They're confident investors who have experienced some sort of success, usually in business or other projects. Now, because of their prior success, they may dismiss their advisor's role. Accumulators are risk takers. They want to be in control. So, of course, the most commonly associated bias with the accumulator is the illusion of control. Human beings are not wired for disciplined investing. When people follow their natural instincts, they tend to apply faulty reasoning to investing, those behavioral biases. If this sounds like you, you're not alone. Many investors follow their emotions. Now, to build wealth, you must look beyond the concerns of today. Avoid your behavioral biases and invest for the long term. At Total Retirements, we're emotion managers. We develop deep relationships with our clients and build investment plans to help them stay the course and then avoid defective reasoning. If you have any questions or you'd like to discuss, give me a call. Dee Kerr, I can help.